Have you ever thought about making $1,000 a month from the stock market? Without the hassle of constant buying and selling? Many investors know about covered calls. Others have heard of cash-secured puts. But few realize these strategies can unite into one powerful system, the wheel strategy. Today, I'm going to reveal how investors use the QQQ ETF to generate steady income from options. We'll dive into the wheel strategy, why many choose QQQ, the capital required, real examples, risk management, common mistakes, and if earning that $1,000 monthly is realistic. Let's get started. Before we get into the details, we need to know what QQQ is. QQQ is an ETF that tracks the Nasdaq-100 index. Investing in QQQ means buying into tech giants like Apple, Microsoft, Amazon, and more. Instead of focusing on a single company, you're investing in around 100 of the largest non-financial firms on Nasdaq. This diversification is a big reason options traders favor QQQ over individual stocks. Its benefits include excellent liquidity, tight bid-ask spreads, huge options volume, and lower risk compared to single stocks. Now, let's get into the wheel strategy. It has just 2 steps. Step 1. Sell cash-secured puts. You collect a premium while agreeing to buy QQQ at a lower price. If QQQ doesn't drop to your strike price, great. You keep the premium. If it falls, you'll buy 100 shares. Step 2. Once you own your shares, start selling covered calls. Collect premiums until you eventually sell your shares and then repeat the cycle. This creates a continuous income-generating process. You may wonder, how much capital do you need? Many beginners are often surprised here. Options trade in contracts, and one contract represents 100 shares. Suppose QQQ is priced at $620. Buying 100 shares costs $62,000. Thus, just selling one cash-secured put requires around $62,000 in buying power. For 2 contracts, you'll need about $124,000. 3 contracts will require around $186,000. This strategy demands significant capital. If your budget is $10,000, QQQ might not be the right choice. You could look at lower-priced ETFs or wait until your funds grow. Let's show a real example of selling a cash-secured put. Imagine QQQ is at $620. You sell one put with a strike price of $610, expiring in 30 days, with a premium of $6 per share. Since each contract represents 100 shares, you collect $600. In the first scenario, if QQQ stays above $610, the option expires worthless. You keep the $600, equating to a return of almost 0.98% monthly on the reserved cash. In scenario 2, if QQQ drops below $610, you buy 100 shares at that price. You've already collected $600, so your effective purchase price becomes $604. Now, let's talk about the covered call. Once you own those shares at $604, you might sell a covered call with a strike of $630, collecting a $5.50 premium. That results in an income of $550. If QQQ stays below $630, you keep both the shares and the $550. Next month, you can sell another covered call. However, if QQQ rises above $630, you'll sell at $630, gaining $26 per share. Add that to your covered call premium and the earlier put premium, and you could generate a total profit of $3,750 before taxes and commissions. Afterward, simply restart the wheel strategy. So can this strategy generate $1,000 per month? Let's calculate it. Consider the put premium of $550 and the covered call premium of $500. This totals around $1,050. But remember, you don't get both premiums at the same time. The put premiums come before owning shares, and covered call premiums follow assignment. Your actual income can vary due to market volatility, strike prices, and other factors. Think of $1,000 as a target more than a guaranteed salary. You also need to manage capital properly. Avoid putting all your money into one wheel position. A safer approach involves diversification. For example, if you have a $250,000 portfolio, consider using 40% for QQQ wheel, 30% for broad market ETFs, 20% in bonds, and 10% as cash for future opportunities. This allows flexibility amid market downturns, letting you manage assignments effectively. Now, let's talk risk management. Some mistakenly think the wheel strategy is risk-free. It's not. It manages risk differently. For example, a market crash could drop QQQ from $620 to $500. You must still buy at your set strike price if assigned. Your premium lessens your loss, but it doesn't erase it. The solution? Only sell puts on assets you'd like to own long-term. Also, avoid over-leveraging. Only sell contracts your cash can support. Don't use margin unless you're aware of the risks. Be cautious about chasing high premiums as they often come with high risk. Ignoring position size can also be deadly. Keep any single position from dominating your portfolio to reduce concentration risk. Finally, avoid making emotional decisions. Stick to your predefined rules and strategies. Let's visualize a month using the wheel strategy. For a portfolio of $125,000, you could start by selling a cash-secured put in week 1 for a premium of $650. By week 4, if you're assigned, you can sell a covered call for another $550 the next month. As your shares get called away, account for a capital gain of $2,000 from the shares. Overall, you could collect $1,200 in total premiums. Then, you can restart the wheel. Always remember, results will vary month to month. New investors often stumble by selling too many contracts or chasing premiums without a strategy. So who should use this strategy? If you are comfortable with some risk, have sufficient capital, and seek to add income streams through options, then the wheel strategy may be for you. To recap, the wheel strategy involves selling puts to generate income, buying shares, and then selling covered calls. To maximize your success, ensure you manage risks and diversify wisely. Ready to start? Dive deeper into these strategies to see how they suit your investing goals. Don't forget to like and subscribe for more financial insights.